Hello everyone, and welcome to another edition of Ask Mike, where our members have the opportunity to write in any trading related questions that they want and get detailed coaching feedback like this sent back to them in video format, and then we take these videos and share them with you guys. But one of our members wrote in several questions around day trading options and managing risk, and so I want to share that with you here. So first part of the question: how do you manage risk day trading options, and how do you know if the spread between the bid and the ask is just way too wide? I went back and reviewed that great day trading options bootcamp video you did for us Mara Elite members. Thank you very much. And you said that it's really relative. One of the examples you gave was about how a 50-cent spread on a $1 contract is huge, but a 50-cent spread on an $8 contract really isn't that bad at all. So to answer your question, you really want to break out the calculator, right? Because you're going to be calculating this on every time that you do it. But in general, a good rule of thumb is that you don't want the spread between the bid price and the ask price to be more than about 20% of the contract. So to go back to that first example that you gave, let's use the contract that's $1. On that, you wouldn't want the spread between the bid price and the ask price to be more than about 20 cents. Anything more than that, and it starts to become too wide, where if price suddenly moves against you, you could lose significantly more and lose just getting in and out of that trade. So that's why we like to have a relatively tight bid and ask spread. For the second part of your question, how do you manage risk day trading options? Well, first is going to be looking only at options where you have that tighter spread, absolute maximum spread of 20% of the contract. But the other way is, well, when I'm going to do a day trade in options, I'm treating the risk to be approximately half of what the premium that I paid for that contract. So to use that $1 contract example, when I buy contracts that are $1, I'm treating 50 cents to be my risk. So it's like I'm losing 50% of the contract. Options are obviously very volatile, and so like when I lose half of what I bought the contract for, I'm treating that amount as my risk. It's very seldom that I would lose 50% of the contract, but that I'm giving myself that kind of a buffer. Just in case if price rapidly moves against me, I'm never in a position where I'm going to blow up my account. And a big part of winning at trading is longevity. You never want to be in a position where you can blow yourself up. It's better to have slower profits that could build and compound over time, and then that becomes the true magic of winning in the market, is allowing those smaller wins to continue to compound over time. If you have all the money or too much in a single trade, yes, you can make a lot of money faster, but it's just going to take that one sudden move to blow yourself up. It's not worth it. In fact, it's almost like what happened with the people in GameStop, those hedge funds that blew themselves up 1,000 to 1 that a short squeeze would happen on that trade. It happened, and those hedge funds are paying the price. Everybody has to manage risk. The little guys like us, and everybody that's participating in the market. Okay, question 2. can you walk me through an example of how you define your reward to risk on a day trade when you're buying call contracts? Absolutely. Let me switch screens over here and walk you through an example. Okay, so here is a fine example of a stock that would be suitable for day trading. The one today is PayPal. The reason why I like it for day trading is because it just broke into new highs. It's in an uptrend on all the higher time frames of over here on the monthly time frame, here on the weekly time frame. Today on the daily time frame, it had just exploded higher to fresh all-time highs, breakaway gap, massive volume, and the relative strength line is also leading the way. To me, this makes for a great day trading candidate. So I then come over here to the intraday time frames. So let's make this one bigger here. This is a 30-minute chart. I would actually go down further. Let's take a look at a 5-minute chart. And then on the 5-minute chart, this is where you can start to see some of the patterns that we might normally trade on a weekly time frame or a daily time frame start to show up. What I'm seeing right here on this breakaway gap, right? I wouldn't buy that per se, but I would sit and wait. And what happened here was what I'm seeing is this inverted head and shoulders pattern, right? And you could also see too, like how it started to tighten up and start to break out right over here. So right over here, then, that is where I would look to enter. And let me take that arrow off. Okay, great. So what I would want to do then is I would get in right here, have my stop loss pretty tight, and I would look to potentially target a run towards the high of the day. In this example, it's giving us a 5-to-1 reward to risk. And let me click on this and get those stats out of here, so that way it's not in our face, right? But so basically, we have a 5-to-1 reward to risk, potential reward to risk, if we make a run towards the highs. Amazing. So price breaks out and it never falls back below where we have our stop loss back here. Price starts to run and then it starts to come back in. On that first sign of weakness, I am selling something, right? So it was holding this 5 exponential moving average. And as soon as it started to break that, because options move so much faster than the price of the stock, I would be looking to sell right there. Sell at least a portion of the trade there. I would probably be out of about 10 to 20% of the trade right there. Then it continues to consolidate sideways. And by the time we get to the close over here, right, it's starting to rally, but with only 5 minutes left to the close, I'm looking to exit the entire position right here, right? Because nothing else would have taken me out of the trade. We didn't fall or break below support. It was kind of riding this 21 exponential moving average on the 5-minute time frame. Didn't trigger anything else, but I don't want to be in a position where I am stuck holding this day trade overnight. I don't want a day trade to all of a sudden turn into a swing trade. Might it work out where it rallies tomorrow? Sure, but we always want to maintain the intent of the trade. We don't want any trade to turn from a day trade into a swing trade or vice versa. So it's very important to that when I talk about intent and planning, this is what I'm talking about. And all of that is done when before we even enter the trade. Okay, so here's the last question, kind of a comment or statement. I usually buy the breakout when the daily chart shows a newer high for the stock, yet I found that buying the dip presents more optimal results, but only when I see a clear reversal. Anticipating hasn't been my thing. I'm more of a point and shoot the target kind of trader, looking to enter on there, then leave a stop loss or a target. Also, what's selling at the close and selling into strength? Kind of just went over that. I recall you said selling at the close is selling at least 30 to 10 minutes of the trading session, but unsure how to execute that. Thanks a lot. Yeah, so we just went through that. Within the last few minutes, I am exiting the trade if there's nothing else. But I wanted to unpack some of what you said in your statement. And the thing that I would want to suggest, this is true for anybody watching, there is no one right or wrong way to trade. I shared a little bit of how I go about executing, but that doesn't mean that it's the right way or the wrong way. It's right for me. And we all need to develop what's going to be right for us. So that begs the question, well, what's right for us? What's right for us is going to be a combination of what leads us to our goal. Right. Well, we've got goals for trading, financial goals, all different types of goals for trading. What leads us to our goals? What fits our trading beliefs? And what are we able to execute well? You have those three things, and you're golden. So, well, we need to figure out what our trading beliefs are. And from your comment, it sounds like you don't. At least so far. Let me read it again. I usually buy the breakout when the daily chart shows a new higher high for a stock, yet I found that buying the dip presents more optimal results when you see a clear reversal. That is an example of a trading belief. Okay, let's go further. Anticipating has not been my thing. That's representative of another trading belief. And just because it has not been your thing yet, that doesn't mean that it cannot be in the future. It'll be on you to decide if you want to try to make it your thing. But if not, if it's just like, you know what, this just doesn't feel right, it's not for me, great, toss it. You don't have to do anything but in the market, but do what feels right, what the style that feels best to you. More of a point and shoot the target kind of trader, looking to enter and then leave on a stop loss or a target. Yeah, that's perfectly fine too. We want to have those stop losses. We need to cut our losses, otherwise that's one of the things that can lead to us blowing up. And also, for the targets too, that's a great place to have an exit. I like to have two other types of exits. If you recall on the chart, I was using the different moving averages as trailing stops. The reason why I like to use moving averages as trailing stops is because it's kind of like a time-based stop and also a momentum-based stop. So if price starts to just drift sideways, then that gets us out of the trade. And when we're talking about day trades, especially day trades with options and where we've got to deal with time decay, then, well, we don't want to be in a trade that's losing momentum. So that's a way to begin to exit that. And the other type is the backstop, where if price has been running up, it starts to consolidate sideways, but then falls back through the floor. That is what I consider the backstop, and no longer interested. So we want to give ourselves multiple ways to exit in case if there's a fire, right? Like back at pre-COVID, when we were able to go to the movies, it's not just one exit in the theater, there's multiple exits. We need the same thing for trading. So I hope that you found this helpful. Let me know. And for everybody else watching this, feel free to drop a comment below the video. I read them all. And I look forward to talking to you guys. Take care. Much love. Peace out.